Hi, I'm Adam Thurgood, Managing Partner of Hightower Las Vegas, and I'm joined for our client briefing, as usual, by Rayna Penilova. Welcome to the briefing.
Thank you. Thank you. Always great.
Yeah, I think before we get going, though, I should acknowledge you have a few letters after your name. Congratulations on getting the CFA designation.
Yeah, thanks. It's a great feeling always when you accomplish a challenging goal like this. And hopefully I picked up a few good habits along the way. Learned a lot about discipline for sure, especially during the summer when you want to enjoy yourself the most. But I think it was worth it at the end.
Well, I know you gave up a lot of time with the family over the past couple of years to get that done, so congratulations. We're proud of you.
Thank you.
So today is going to be a conversational style client briefing. I'm going to more or less interview Rayna and chime in from time to time. And I think this most natural starting point is just to recap what's going on in markets. It's been another solid year. We've seen the S&P 500 rise a lot. We've seen international markets go up even more. Gold's been on a tear. So give us some background on what's happening there.
Yeah, I think the story of the year is really that we're having another great year, but also that now it's a little bit different with diversification working a little bit more, gold, the international markets, other natural resources doing quite well this year. But when we really focus on U.S. markets, for example, if you look at a chart of the S&P 500 compared to the equal weight index, the one where every company is given the same share of the index, we can see that the S&P is having a great year with 16% up after 3 years straight up. That's still a great story. But then underneath the surface, there's quite a bit of weakness. Actually, we have over 40% of the index now in a downtrend currently, and then the equal weight index is only up about 7%. Still a good year, but not quite as great as the overall index portrays it to be.
Well, it's really still largely about the big tech companies and the AI story.
Yes, absolutely. So if we focus on concentration, for example, it's again what's driving that market. It's not only concentration within our index, but globally. Like if we look at another chart that we prepared here, we look at the global equity landscape and then compare the U.S. share of that. And then we're only looking at the period since 1990, which is a period of U.S. dominance overall. And during that period, we've had the S&P U.S. stocks now currently having 70% of the share of global equities, while since 1990 it's been closer to 53%, so still a larger share than you would expect, given that we contribute about 26% of global GDP throughout the whole period and today as well. And then on top of that, we have the top 10 companies in that index now contributing 40% of the index. That's very concentrated. That's usually that number sits around 25. When it comes to valuations of those companies, those are also sky high. So a very, very exuberant market. I think it's all because of the expectations built in. We also did a little study that we're depicting over here in a little graph too of what's priced in the market right now. So currently the market is expecting pricing in earnings per share growth of 10% next year, 12% the following 12 months, while sales are only expected to grow about 5-6% both years. And that's all based on the expectations of profit margins, which are already at record levels, continuing to grow. So it's very, very positive. Of course, we know AI is a big story here, technology, U.S. dominance when it comes to technology. And perhaps, there's quite a bit of truth built into that, but we'll see if we're priced for perfection and if we can deliver perfection.
Yeah, I mean, part of the risk is that expectations are high, margins are high, valuations are high, so the potential disappointment canvas is pretty wide. I mean, we could see something go wrong just from a slight disappointment. So we're keeping our eye on that component of it, but let's dive into the AI space a little bit more. What is going on there? Why is there so much investment in all these data centers? at such enormous levels.
Yes, everyone is talking about AI, and not only here, globally. That's why the U.S. continues to suck in capital because of that AI story, and it's really about that data center build out. The companies that are really focused on building out the data, all the data centers that we need to process large language models are called the hyperscalers. There's 4 main ones. They're all part of the top 10 companies in the index, and their business model is really transforming. If we look at capex compared to revenue for those hyperscalers, we can see that on average they usually run about 7% of basically building out new capacity compared to the revenues they received, and now that has really skyrocketed up to 17%. So that's really a different sort of business. One reason why those companies were so successful in the past 10 years or so is because of the asset-light business model that they had, and now that's completely not the case anymore. So we have to think like, okay, the market obviously expects them to produce gobbles and gobbles of revenue to offset those expenditures. So is that likely to happen? And that's a judgment that we have to make. But the story really is that hyperscalers and AI-related tech names are really locked in this prisoner's dilemma. Basically, it means that if you don't invest enough in AI, you can become irrelevant and just become run over. So everybody's trying to invest the maximum they can so they can take market share and they could become the next winner, which inevitably leads to overinvestment. And that's really like a story that has happened again and again with new technologies. It happened with railroads in the 1900s. It happened with the rollout of the internet.
In the late 90s.
Infrastructure in the late 90s.
Happened with Shell Oil about a decade ago.
Yes. Again, and you could see like it makes sense. If you want to be relevant in that space, you have to be the winner in AI. You can't let your competitor invest more than you do.
Yeah. I find it interesting though that if you look back at say the success of a Facebook or a Google or some of those companies, it was really about the network effect. You were on Facebook because everybody else was on Facebook. I'm not sure that the large language models have the same network effect, and you may end up having a lot more competition as a result, and people will just switch from large language model, they'll go from ChatGPT to Claude or whatever, based on what's cheaper or based on what's more convenient. So you may not get that same network effect. So this massive capital investment that we're seeing could end up with much worse returns if that's the case.
Yes, that's definitely one of the components going on right now. And also, usually when a new technology emerges and it requires investment, like we see today with AI, the long-term winners are the ones that can benefit from that infrastructure build-out without having to put in the initial investment. Yeah. So in the past, Facebook, Amazon, they benefited from the capacity already being invested in from the telecom from the telecom companies, from Cisco in the 2000s.
Yeah. And really the end consumer benefits too, because when you have overcapacity, you end up with cheaper prices. What we saw when there was a big tech boom and communications boom in the late 90s, you ended up with a lot of fiber optic cable in the ground, which made the cost of internet cheaper. We saw the same thing happen with the energy boom in the US with Shell Oil. We ended up producing too much oil and the price went down and the consumer benefited. So we'll probably see something similar, I would guess, on this, as long as everyone doesn't lose their job to the overlord of AI.
Yes.
Which is a potential risk, but we use AI in our business to help us analyze markets and vet ideas. And while it's highly impactful, it's far from being at a place where it gives you perfect answers every time.
Yes, I think part of the story there is that markets keep evolving, and we AI helps us analyze, get to the bottom of how things are currently and how they were in the past, but that doesn't necessarily take into effect everything going on and anticipate the future. So I think
by definition, it's basically a statistical model that predicts what happens next based on what has happened in the past. So if something happens in the future that hasn't happened in the past, it can predict it. By definition, cannot predict it. Yeah. So we haven't exposed ourselves too much to the big hyperscaler businesses because of valuation concerns. For instance, a company like NVIDIA is worth more than the entire German stock market. To us, that is a little bit odd. But we have been getting exposure through what we would call AI adjacent names. So tell us a little bit more about that.
Yes. So when you invest in new technologies, you tend to focus on the S-curve of innovation. And that basically is supported by what's called the Amara's law. The fact that when it comes to new technologies, we tend to anticipate the effects of the technologies early on and overestimate them, while we underestimate the effects in the long term. So where you really want to invest is in the companies that you think are going to benefit from AI in the long term. And we think that there's quite a few names that achieve that task. For example, robotics, when it comes to humanoid robotics, which Tesla expects for us to all have a little humanoid robot assistant in the future, or really factory automation. I think that's a really big story. Automating, Amazon is automating all of their facilities, for example. So there's quite a few biotech companies are an area that could benefit from AI when it comes to discovery portion of their business. So we really try to focus on these themes and do deep dives in the companies that we own to see which ones have the potential to benefit from AI rather than become disrupted by it. And then there's another component where we're looking at AI adjacent names that are currently part of the story, but perhaps they're not fully valued. For example, South Korean companies, high bandwidth memory is a critical component of AI data center build out. The leading company, the South Korean company, and it's trading at 5 times lower valuations compared to the US competitors, which don't even have the technological edge there. So there's these, if you really look hard, you could find areas of where there's a lot of potential there. And like that approach has paid off this year. Like the companies that we have that are related to that story, they've caught up pretty well with the leaders.
Yeah, South Korea has been a great place to have money allocated this year.
Mm-hmm.
Well, when we think about the overall risks that we're seeing in the market, obviously there's a pocket of potential disappointment because expectations are so high. We're also looking at a potentially weakening job market with the Fed now cutting interest rates, potentially trying to cut off, any sort of economic weakness. And we're in a strange place where if the labor market weakens substantially, then you're going to get a negative feedback loop because people that lose their jobs don't spend money. And then when they don't spend money, corporate profits go down. And when corporate profits go down, CEOs fire more people. So it has a negative feedback loop. And in that case, if that plays out, you probably see interest rates fall fairly substantially, maybe 1.5%, something like that. That would be a great environment for long-term bonds to be a good hedge. But on the flip side, if the Fed is successful in cutting this off because they're cutting rates and trying to spur demand, and we do see a resurgence in growth, with inflation still already 1% or so above their target, if inflation picks back up again, that's going to be a problem and not a great place for bonds. So it's a tricky environment where we really have to think through all the different risks and make sure that we're exposed in an area and a way that protects us from a variety of different outcomes. But why don't we talk about just risk in general? Because I think in times like this, when the markets are doing really well, we get oftentimes inbound calls where their clients are saying, why don't we take more risk? And more risk doesn't necessarily always mean more return.
Yes. And it's such a common belief among investors that high risk investments on average consistently lead to higher returns. So why don't you just always take more risk and just have higher returns? Like, what's the problem there? Well, if that was really the in fact true, then it wouldn't be high risk anymore.
It would be low risk. If you just take more risk and get more return, it would be low risk.
Yeah. So Howard Marks actually depicted this concept by just overlaying probability distributions on the graph we're all familiar with risk and return. And when you do that, you then realize that although on average, yes, high risk investments do lead to higher returns, they also are associated with much higher risk of suffering substantial drawdowns. And that really matters. When you lose 50% and gain 50% subsequently, then you end up 25% lower than when you started. So the starting point really does matter. And we have to be hyper-focused on that, especially in today's world when valuations are already pretty rich. So when you look at the last 15 years, it's very easy for people to conclude that diversification really doesn't matter, and it just is a drag on performance. I mean, the S&P 500, as you can see here, completely killed every asset class in the last 15 years. But all you have to do is look at the prior decade to see a completely different set of outcomes where the S&P was down, gold outperformed, international stocks outperformed, but not only that, things like energy stocks outperformed massively too. So we have to really start to think about risk in a different way. Like, what's the best hedge here? How do we protect the portfolios? Where should we take risk and where should we really try to hedge the portfolio? And we really do that by focusing on correlations between asset classes. Those tend to evolve over time. Each asset class is affected by a distinct set of economic and structural forces, which obviously change. So the relationships are really dynamic. And that's why we have all these models, different ways of looking at the situation, at the macro landscape, to try and anticipate those shifts and add the hedges to the portfolios really that we think have the highest probability of offsetting stock market declines when they happen. And a great example is energy.
Yeah, energy historically has been 10, 12, 15, even as high as 25% of the S&P, and today it's about 3%. So the S&P is now dominated by energy consumers and has almost no exposure to energy producers. And the really ugly bad bear markets tend to occur when you have elevated energy prices when the economy is weakening. And so we believe that you have to be very careful about that outcome. And energy in general, having an overweight in that sector, helps to provide an inherent hedge inside of the equity allocation. Now let's talk generally about the conditions for stocks right now. We have a lot of different models that we look at to give us a sense of how markets are doing and where we think they might be headed. And for the most part, the models are still saying that this is a pretty good environment for stocks.
Yeah. Well, when we look at some of our main models, for example, which try to estimate our is now a good environment for equities. On the fundamental basis, they still suggest that yes, we should be investing in equities. Globally, growth is picking up, inflation is not picking up, or it's slowing down in some places. Now, we may anticipate things to change in the future, but currently that's the situation. We have good environment for stocks. That's probably is part of the reason why we have these rich valuations currently. When it comes to the preferred hedges that we also focus on a lot is gold is still the preferred hedge. Now, not as much as it was in the beginning of the year when really bonds offered no value whatsoever across different economies. Now we're starting to see bonds starting to offer value in some places, and gold has enjoyed a remarkable rally, up 54% so far for the year. So our models do suggest that both on trend basis but also on fundamental basis that we should be focused on gold, but perhaps not quite as much as we used to be.
Well, I think it makes sense to explain this chart in a little bit more detail. So if you could pull that chart back up. What we're looking at here is the environment for when gold and bonds make the most sense. And if you look at that far right-hand bottom corner, that gold star, that's like the nirvana area for gold, when countries around the world have no fiscal discipline and are debasing their currencies or printing too much money, and yield curves are flat. And what we mean by that is you would want to be compensated more if you bought a 10-year bond than a 3-month bond. And when you don't get compensated for that, then that would be, let's just call it a flat yield curve. It could be inverted, but let's just keep it simple. So the best environment for bonds is when you have a flat yield curve and countries debasing their currency. Sorry, the best environment for gold is when that happens. The best environment for bonds is when yield curves are steep and governments are behaving. And we're far away from the top left corner there, so we're still thinking that gold is the better hedge going forward.
Yeah, and speaking of precious metals, we should also talk about silver, which has also had a remarkable run. There's a lot of investors who anticipate for that to continue, and it's a very contentious topic out there in markets, and it's because it's this unique corner. If you, for example, look at the supply-demand dynamics for silver, we could anticipate, so currently silver has a supply-demand imbalance where we have less supply than we have demand. But silver is also a critical component of electronics. So the AI data center build-out could be expected to increase substantially the demand for silver in the future. So you have a metal that is not only a precious metal, and gold has run up a lot, so you could expect for silver to catch up to that, but you also have that AI-related story. So it's a very interesting corner of the market that really represents both ideas of having a hedge against debasement and inflation, but also having an exposure to that dominant theme out there in the markets.
Yeah, and when silver gets going, it really gets going. So we're keeping a close eye on it because we don't want to own these things blindly. We need to make sure that the fundamental case aligns with the technical case. And right now, we're feeling okay about it, but silver's sort of a canary in the coal mine at times about weakening growth. So we're also keeping a close eye on that as well.
Yes.
So any other big picture thoughts you want to share today, or do you think we've covered the bases?
I think we've covered the bases
right.
today.
Okay, well, we'll leave it at that for this time. You know where to find us. If you have any questions, don't hesitate to reach out. And we will be, I'm sure, writing some articles and be back on the camera before too long. Thanks for your time.